Hello, Energy Financial Modelers. In the last video, we talked about how to get from our daily production, look it up historically, forecast it, and then multiply that by some price forecast to get our sales line for the income statement. In this video, I'd like to expand on that and talk about the differences you might see on an oil and gas template versus a standard template. Granted, this would have been a much better lecture earlier in the semester, but there are no books on this stuff that I've found. And as we've progressed through our projects in preparation for the final, I've learned a lot that I want to share with you. Most importantly, I want you to leave this course with a better oil and gas template than you have. Now, I have stressed to all my sections, do not sweat the restatement. You're going to pull up some 10K and Edgar data and put that into a template, and I will be as generous as humanly possible on helping you do that. So I don't want you to sweat that, but I do want to spend a little bit of time talking about it. So in this file, I'm comparing our oil and gas template to our standard template. Let me zoom in a bit. And what I've done is taken the standard template that you are used to seeing. Starts with sales. I think I had it renamed for the last video. Starts with sales, takes off cost of goods sold, gets you to a gross profit, takes off overhead, gets you to an EBITDA. So let's think about how that's different in an oil and gas company. If you're practicing looking at some oil and gas companies to get ready for the final, you may be seeing things in addition to revenue from sales. You may be seeing gains on sales of assets, gains or losses from hedges, and other types of income that we could add up for total revenue. Now, I thought about just asking you to slam it all into the standard statement, but I actually think that by providing you more options, it will be easier for you. The reason I think that is I did some research. Let me show you the research I did. I looked at 15 different companies, and I looked at how are they reporting their revenues. Well, 12 of them reported production revenues. Over half of them reported a gain or a loss on sale of assets, and a full third of them reported gain or losses from hedges. Now, about half or more reported some type of other income, and it's always nice to have an other line on a template. And that's why I have on your energy template 1, 2, 3, 4 lines adding up to total revenue instead of just a sales line. Again, don't sweat it for the final, but we're still trying to learn as we go. And those are things we can learn. Similarly, as we jump over onto the expense side, every single one of those 15 companies listed something that they called either lease operating expense, production expense, production and operating expenses, operating costs, lease and well expenses. You get the idea that these are the types of expenses that one has to pay to operate some wells on a lease. And so all 15 companies had that line item. So I thought, well, let's put that on the template that you leave this class with. And then over half, right at 2/3, had some kind of gathering, processing, and transmission cost or transportation cost. One company even broke those two out separately. I don't know why. That was EOG. One called it shipping, handling, and other operating costs. I got a kick out of that one. But in general, it was GP&T. So I think on your template, I'm calling it GP&T. So think about that as cost that a company pays to get their product to market. And then thirdly, there was severance and ad valorem. Many companies call that taxes other than income. I was surprised that only 13 reported severance and ad valorem because I promised 15 of these companies pay severance and ad valorem tax. Severance is a tax that state or local authorities, I don't remember, charge to get a product out of the ground. So the state taxes us for producing that product. Counties tax you if you own assets, personal property items that you use in a business, or pumping units, for example, things like that. So whether we call that taxes other than income or whether we call it severance and ad valorem tax, in practice I generally called it SevAd tax. And so only 13 companies reported it. I'll bet the other 2 had it buried somewhere in their LOE or in their other expenses. And then there's exploration. 14 out of 15 reported an exploration cost. Some called it exploration expenses, including dry holes and lease impairment, including some undeveloped lease amortization, blah, blah, blah. One broke out a separate line for dry holes. So for your template, I called it exploration and dry hole costs. Moving on, there were some other expenses that were sometimes associated with different types of businesses. For example, Chesapeake has a thriving marketing business. Devon has a pretty strong marketing business. Continental has a service operations business. Many companies like ConocoPhillips here would purchase commodities and then resell them. I think that was how Devon reported it as well. So some of these would offset some numbers up in the revenue column. Purchase commodities was broken out separately by Oxy. So I left that in there as an other expense. And then every single company reported something that they called general and administrative. One actually called it selling general administrative. That was ConocoPhillips here again, a little bit closer to the integrated side than most of these independents I've come up with. Another one, Oxy, selling general administrative. But I just call that G&A. I think in our standard template, it was SG&A. And then DD&A, which is on our standard template, every single company called it depreciation, depletion, and amortization. I think one threw in a little bit of accretion in there as well. So DD&A is a standard line item on your template. Impairments. Since we are in the oil and gas business, 13 out of 15 companies had listed some kind of impairment. This is a reduction in a balance sheet account, asset account, that they had to record on the income statement to get everything to match. You learned about that in accounting class. So I went ahead and included an impairments row on your template. And then we move to asset retirement obligation accretion. About maybe 20 years ago, the FASB came out with a rule that said, you're going to have to plug those wells someday. And so you should start building up a liability on your balance sheet that indicates that you're going to have to plug those wells someday. And so each year that goes by, companies take a non-cash expense on their income statement that represents what wells they will have to plug in the future. The idea being that when they eventually plug those wells, they'll have that liability listed on their balance sheet and they can simply plug them and not see a huge change in their value. Restructuring costs, again, since we're in the oil and gas business, about a third of these companies had recorded some kind of restructuring or termination or separation costs. With all the layoffs we're seeing this year, you'll see a lot more separation and termination costs next year. So I listed that as an item on the template as well. So let's jump back over to the template. And so here are those 4 types of income that I talked about. Here are those many types of expenses that I talked about. And that gets us down to our version of EBITDA. Now, I hope this doesn't frustrate you. If you're frustrated about the final, you may be saying, that guy took 4 lines and turned them into about a dozen. But I actually think when you pull up the companies that I give you on the final, you'll find it easier because you'll find something that matches very closely and you'll have a place to put it. Now let's talk about EBITDA and EBITDAX. EBITDA is our earnings before interest, taxes, depreciation, and amortization. Well, if you think about it, interest, taxes, depreciation, and amortization are things that aren't really those direct costs of the business. So DD&A comes out before our version of EBITDA, but also what else comes out? Exploration costs, also dry holes included on this line item. So money that a company spends on exploration is seen as a longer term investment, and so wouldn't be really analogous to a cost over here that's coming out of EBITDA. And so we talk about EBITDAX since we have exploration costs that are below that line. That gets us down to our total operating expenses and earnings before interest and taxes. And so we're kind of synced back up now on this earnings before interest and taxes line. We take off our interest expense, add back any income, we get our net interest expense and any other expenses. And then we have this earnings before taxes, which lines up across both. We take off our taxes. But then what I saw on many of in fact, let's go see how many. I saw about 4 out of 15, so almost a third of the companies talking about continuing operations. When an oil and gas company sells an asset and it's no longer an operation that they're going to continue with, that's a big deal, and it affects the numbers dramatically. So when you see that on your income statements, I wanted you to have a place for it. The next thing that they would put, and all of these were in this order, is non-controlling interests. So remember, we saw a lot of non-controlling interests on the standard template, the companies that we were doing with the standard template. If a company owns a controlling share, but not the entire share of a subsidiary, they include that subsidiary in all their sales and costs, but then for the portion they don't own, they have to back that out as a non-controlling interest. And then finally, what I saw with the energy companies, much more than any of the other companies that we saw, were preferred stock issues, participating securities, loss on preferred stock exchange, items like that. So when you look at an income statement for an energy company, instead of just getting down to that net income, you're likely to see some adjustment for discontinued operations, for non-controlling interests, and for preferred stock issues. And then we're back synced up with our net income, from which we'll take out dividends to get retained earnings, and then they'll show the share counts. So please forgive me if you find this frustrating. If you find it frustrating, just pretty much ignore it. But when you come in to do the final, you're going to see this template. The balance sheet template will be the same, but for the income statement, I think you'll find this much easier to translate the companies that I give to you for the final. And in the next video, I'll walk through the mechanics of that.